Good morning and a warm welcome to you all. Welcome to 1 hour on capital allowances led recovery. I'm John Lovell, Director of Capital Allowances Specialist Lovell Consulting. I will be joined later on by my colleague Richard Massingham. We both have broadly similar backgrounds. In my case, I've been specialising in capital allowances for more than 30 years. My original background before going into tax was in surveying as a quantity surveyor. So we will be approaching this from a very practical direction. If any of you would like CPD certificates, please make that known to us by sending in an email. And if any of you have questions during this webinar or afterwards have questions, please do feel free to email in those questions. We'll probably deal with the answers towards the end of this webinar, and we do circulate the responses to everyone who has attended. We were teased a little bit when we emailed out this heading, Capital Allowances Led Recovery. Some people said, don't you think you're pushing things a little bit there? However, in fairness, I think Mr. Sunak did very much in his budget 2021, which has now found its way into Finance Act 2021. His real tool to try to stimulate things has been generous super capital allowances, and we'll be taking you through what the implications, what the benefits, and some case studies. So he's a very popular man in the office, Mr. Sunak. He is the prime person behind super capital allowances. So yes, he is something of a superman in the capital allowances industry. And the really positive news is, for the first time, we have 130% capital allowances for general pool plant and machinery. I don't think it's ever been so generous in the UK as 130% first year full write-off for investment in general pool. And he has substantially speeded up the allowances that are available for integral features plant. There was quite a bit of confusion early on when these allowances were introduced back in March, and the confusion was whether property companies would be allowed or denied these super capital allowances. And thankfully, due to a late relaxation in the debates through Parliament, we can advise that in pretty much all cases, property companies, where they are an owner of a building and as a holder property as an investor, they should be able to claim super capital allowances on landlord plant and machinery, which is leased to tenants. So that is good news for the property industry. The other good news for trading businesses is prior to this Finance Act, losses for trading businesses could only be carried back 1 year. That has now been extended for trading businesses for a further 2 years, but capped at 2 million of losses that can be carried back in year 2 and another 2 million in year 3. My colleague Richard will be taking us through what it means for free ports and what the tax benefits are if you locate within a free port. There is a substantial cost to the Treasury of these relaxations. Just the super capital allowances will cost over the next few years something in the order of 29 billion. So the Treasury very much are using allowances as a tool to stimulate the economy, and the loss back provisions are estimated to be less costly, in the order of about $1 billion. And there is, of course, some less positive news. Boris has had a tough night yesterday with his friend. If you were listening to Dominic Cummings, I did hear that Boris was approached by Prince Harry's ghostwriter. He suggested that maybe his memoirs could be Women, Wives, and Wretched Cummings. But the bad news here in terms of capital allowances is the super capital allowances only apply to companies. They are denied for individuals and LLPs. And for general leased plant, this is excluded. But as I mentioned, where a landlord leases plant, it is possible for the landlord to claim super capital allowances. The other bad news potentially is that the corporation tax rate will increase to 25% in April 23. I think we need to watch that space. I'm sure Mr. Sunak will, if he possibly can, if there's a strong recovery, why would he want to go straight from 19% to 25%? That is quite a steep increase. So I think we'll have to see what happens in terms of the UK recovery and the global recovery. The other less positive news is the annual investment allowance, which is currently set at 1 million. So the first 1 million of any type of plant or machinery, you can get tax relief all in the first year. That will reduce from 1 million to 200,000 in January next year. Also, the slightly unfortunate thing, if you're a property business, you don't have the ability to carry back for 3 years. So that only applies to trading businesses. In terms of the UK total tax receipts, the benefit of the super capital allowances is for corporates. And in the UK, corporates tax raises something in the order of about 45 billion. It's a much smaller number than probably what the man in the streets would expect. And as a percentage of all taxes is tiny. So it is expected to rise in 2023-24 onwards. I think that must be based on the increase in corporation tax to 25% and potentially predictions of an economic recovery. But corporation tax as a whole is a relatively small number compared with payroll taxes. Now, you may be wondering, well, how will super capital allowances impact? And if we look at, say, two large companies here, this is a slide that I have lifted from TaxWatch UK and amended. So Amazon, clearly a business that's in the news a lot. It gets critiqued for paying relatively small amounts of corporation tax in the UK. But what will be the impact for someone like Amazon? Well, if you assume that their level of expenditures are going to be broadly similar going forwards, then it will be quite dramatic. So on very simplistic calculations, at the moment, Amazon benefits pretty substantially from capital allowances and probably writes off something like 29 million of tax. Additional capital allowances additions are in the order of 29 million. But this is likely to increase with super capital allowances to tax relief on 211. So a dramatic difference. So other things being equal, for the next few years, you'd expect Amazon to pay almost no corporation tax in the UK. And similarly for the national grid, as you'd expect, they have huge capital expenditure, and in a normal year, they're probably offsetting capital allowances in each year of something like 825 million. With super capital allowances, that tax deduction would increase to almost 6 billion. And again, for a company like National Grid, it would probably wipe out any corporation tax within the next 2 years. Now, clearly, it will depend on levels of investment going forwards, but the message is getting through in the business press. There's articles in Sunday Times, in the Sunday Telegraph quite regularly saying, look, businesses have never had a better time to invest in capital expenditure, claim these super capital allowances, build up a shelter before a potential 25% corporation tax rate. And this here is a picture of Google's new building, which is well underway in King's Cross. Clearly a company like Google, if they're investing significantly in the UK, which they are, as are Apple, as are much smaller businesses, should have a substantial benefit from these super capital allowances. Unfortunately, probably for Google, they did start this project before super capital allowances were introduced in April this year. So for a lot of the expenditure on this project, they will probably only be entitled to normal capital allowances. And I think one interesting factor is you'll all be aware that banks, the banking sector, post the 2008 crisis, they do pay higher corporation tax. There's an 8% surcharge. Will that 8% surcharge still be in place if corporation tax rises 25%? Because 25% plus a further 8% would be a pretty uncompetitive tax rate globally. What it does mean is if you can claim all the capital allowances that you are legitimately entitled to. And the great thing about this subject is it's not tax avoidance. The examples that we'll be coming on to are all completely legitimate examples. Pretty much all governments have encouraged individuals and companies to invest in buildings and equipment. They see it as being good for the economy. And as a result, not just the UK, but all countries around the world tend to give tax relief for investments in infrastructure, property, and equipment. Now, let's have a quick look at what has changed. So, pre-budget, you had 150% tax relief for decontaminating land. This, in fact, is still the most generous tax relief. No change to this in the budget. Currently, no change to the annual investment allowance, albeit it will reduce in January. The big change is to the general pool, plant and machinery, which I'll come on later to define. You can now claim 130% provided you're a corporate entity. And the same for integral features. Previously, these had very slow tax relief at just 6% on a declining balance basis. You can now write off 50% in the first year. You can also still allocate the annual investment allowance to the integral features to get a full 100% write-off on the first million of integral features. No change for any expenditure on repairs. So this is very much an underclaimed allowance. We see a lot of cases where companies do incur expenditure on repairs. It all gets capitalized in the accounts and is very often not segregated and the tax relief is not properly claimed. There are now, of course, the free ports, which Richard will discuss. And the other big change was the 3-year carryback for companies. So some key points here, just bear in mind that super capital allowances only applies to new expenditure. So if you buy second-hand equipment, it will not be applicable. It may be applicable if you're buying a building from a property developer and that building has not been used, so it's not been let, then super capital allowances may apply if you're the first person to buy that building. And a landlord can claim super capital allowances on capital contributions towards tenants. So if a landlord gives capital contribution of, say, £1 million to a tenant, if it's been properly allocated and there's been appropriate wording in the agreement to lease, then the landlord may be able to claim super capital allowances on some or all of that contribution. And do remember that individuals and LLPs are denied these super capital allowances. They can still claim normal allowances. And do be careful, like the Google example, if there were an earlier enabling type projects, there is anti-avoidance legislation around the start date of super capital allowances. And if you had a significant enabling project which the main works followed on from, that may deny super capital allowances on the future spend. So what kind of savings are we talking about? We modelled for a client before and after these changes what the impact would be on a 10 million fit out. Now, pre-budget, the first year tax saving would have been just under £500,000, and post-budget, the first year tax saving is increased and speeded up to 1.4 million. So it has a substantial cash flow benefit and also extra allowances by multiplying by 1.3. So there is a real kind of fiscal incentive to bring forwards or to carry out capital expenditure whilst these super capital allowances apply. What do we mean by general pool? Is things typically in a building that have a slightly shorter life and depreciate a little bit faster. So things like sanitary furniture, fittings, equipment, IT, computer systems, security, demountable partitions, even swimming pools. So there's not a list as such. This has developed over case law over many years, but it is relatively clear now in case law and legislation what assets qualify for super capital allowances. The other classification of allowances is what we call special rate or integral features. These are typically written off at a slow rate of 6%, but you can now write them off much faster, 50%. And it's things which typically are more mechanical, electrical related, so things like lifts, hot water, heating, air conditioning, ventilation. And do note that the legislation changed in 2008. So since April 2008, we now have a wider tax definition of what these assets are. Make a note of that because it's important in the case studies which are coming up. So here is our first of our case studies. These are based on live situations where clients have come to us for help during this difficult period in the economy. Typically, most businesses have had economic challenges. They've had challenges over cash flow. And capital allowances has been a very valuable tool to help mitigate taxation. And these examples apply to pretty much everyone, individuals, companies. They're not so much based on super capital allowances, they're based on normal capital allowances. In this example, we had a leisure business that had been trading very successfully pre-corona, and post-corona had to completely cease trading, so it was struggling for cash flow. And it had paid corporation tax on account for the successful periods and paid significant corporation tax. And they came to us and said, look, we're struggling here. Is there anything that we can legitimately do to help our business through this challenging time? And we looked at their accounts, we looked at their tax returns, the tax computations, and they had spent substantial monies on redeveloping a leisure stadium and marketing facilities, spent significant capital expenditure. And what we found was that their accountants had only claimed the very obvious allowances. And if there were invoices that said air conditioning, those allowances had been claimed. But if the invoices said building works, stage payments, and the underlying detail was missing, then no allowances had been claimed on that expenditure. So a lot of allowances had been missed. We visited the property, we obtained details from the contractors, we made assessments ourselves where information was missing or deficient, and we put together a very detailed document, and we identified an extra 4 million of allowances that had not been claimed. We worked alongside their accountants. Their accountants then filed an amended tax return, and within about 8 weeks, they received a cash repayment of 300,000 from HMRC. And not only will there be that one repayment, which was very helpful to them, there will be future savings going forwards once they've now basically recommenced trading. So there's advantages for them going forwards. The other good news was they had another project also in the leisure sector at another site where they've been building through the corona period, and that site is now trading. They've got losses, obviously, due to interest and allowances. As a result of the relaxation in Finance Act 21, they can now carry back those losses 3 years, and that will trigger a further tax repayment from HMRC. So very valuable, and I think the message here is if you've carried out projects in the past or in recent years, it is worth revisiting. And there's not really a time limit for carrying out this kind of opportunity. So provided you still own the asset or still use the asset, you won't be able to reopen a tax return from, say, 10 years ago. But if you still own that asset, you can claim any missed allowances in a current tax year or an open tax year. So really advantageous to look back at historical expenditure. Second opportunity, it arose from somebody listening to one of these webinars. We got a phone call after the webinar, and they said, oh, that's very interesting. We have a client where there was a very contaminated site. And we looked into it, and it was a property developer. So in this example, it wasn't a occupier or an investor. It was actually a property developer. And not everyone is aware, but Property developers are not entitled to normal capital allowances for plant and machinery, but they can benefit from contaminated land relief. And in this example, they'd spent about 800 million on a mainly housing development, some commercial activity as well. And the site had been very polluted. Now, the developer was not the original polluter. So the developer bought the site in this contaminated condition. And that is one of the key tests for claiming this tax relief. You can't benefit if you were the original polluter. And there's been a few recent tax cases on this point where people have bought companies and it's been deemed that that company was the original polluter. But here they bought the asset, no connection with the pollution. They were advised by Big Four accounting firms who had not claimed this tax relief. They'd not claimed it because it's a good question. Why didn't they claim it? They probably not claimed it because the invoices just said substructures, excavation, earthworks. It was not specifically noted on the invoices that there was substantive decontamination. Now, by a specialist firm, we visited the site, we obtained all the underlying historic records, and we were able to piece together a document which identified 14 million of land remediation expenditure. We had a couple of straightforward questions from HMRC, which we responded to very quickly. And this client, again, within a matter of a couple of months, received a cash repayment from HMRC of over 3 million. Now, this opportunity is available to companies. This contaminated land relief is regarded as too generous for individuals. So this specific opportunity is just available to companies, including occupiers, owners, developers, and investors. We find that land remediation claims are seldom made for the reason stated that the expenditure is not nicely segregated. There is the opportunity to go back in time. The time limits are more restrictive for contaminated land relief. You can normally go back 4 years, possibly a bit longer than that. Next opportunity was a private school. Again, they'd struggled during the Corona period. They'd had to close the facilities. It was for it was a private school for, I think it was for A-level students. And they had a lot of cases early on of Corona within the school. So they took a decision to close the whole school down. The background to it was they'd bought an office for around 10 million and spent a further 2.5 million redeveloping the property. And again, they said, is there anything that we can do? Cash flow is tight. And they had paid tax on account. And we found extra capital allowances in the purchase. So there was heating, there was air conditioning that was still being used. So we got allowances on the purchase of 2 million and a further 2.5 million of allowances, different types, on the refurbishment. And they were entitled to an immediate tax repayment, amended a tax return, got a quick repayment of tax. We worked alongside their accountants to jointly achieve this saving. And again, there will be further savings now that they have recommenced trading going forwards. This example, again, it applies to pretty much any tax-paying entity. So it would apply equally if it was an individual, an LLP, or a corporate. And it just highlights how valuable it is to revisit earlier transactions. You might be thinking, well, this all sounds very routine, it's very straightforward. Why do these capital allowances get missed? It's a very legitimate question. I think all accountants are aware of allowances. It's part of their training, it's part of their CPD. But hopefully this slide will explain the reason these allowances tend to get missed. So let's assume someone's buying this building for 5 million. And it may be that they're buying the building from a non-taxpayer. So it could be somebody like a pension fund or a charity. Now, if they're a non-taxpayer or even a property developer wouldn't be entitled to claim allowances, they won't have been entitled to claim allowances. So the property lawyers will ask them, have you claimed allowances? And the answer will come back, not applicable. And the whole of the pre-legal questions will just say, capital allowances, what are they? We haven't claimed any, we're not entitled. So as a result, someone's bought this building for 5 million. There's nothing gone in the sale and purchase contract. There's no capital allowances tax election. A lot of buyers, a lot of accountants would just say, well, there's no tax relief. We don't know what the capital allowances history is. There's nothing there. So the allowances tend to get missed. Whereas if you appoint a capital allowances specialist, they can look at the tax history. They can then visit the property. They can segregate out the lifts and heating and air conditioning and so on. They can do a detailed analysis to support the figures. They can then work alongside whoever the accountant's tax advisors are and do a detailed report which then gets included within the tax return. If there are any questions, then the capital allowances specialist can resolve those questions to agree things with HMRC. And this is not avoidance. You're entitled to, it's legitimate. It has to be carried out properly, it has to be detailed, but this is not a scheme, it's not something that's artificial, it's not contrived. So in the second example here, they then carry out a refurbishment and spend, say, 1 million refurbishing it. Then again, you'd think, well, this must be very easy. The accountant's got the records. I'm paying him a fee to get these allowances for me. But the practical problem very often is the information which the accountant receives. And if the accountant just have a pile of invoices that says building works or stage payments, then it's not going to be very helpful. So allowances tend to get missed. Where it's obvious and there's an invoice that says lift installation, 100,000, allowances will have been claimed on that expenditure. But very often what is claimed is tiny relative to the much larger building expenditure. So it's for that reason that allowances get missed when people buy buildings and again when they refurbish buildings. Who can claim normal capital allowances? And by normal, I'm excluding super capital allowances. Well, it's tax-paying entities. So the non-tax-paying sector are not able to benefit. And it's when you carry out economic activity that you can claim allowances. And every time you spend more money, you get a further set of allowances. What kind of owners can benefit? As I've mentioned, property developers can only really benefit from decontamination allowances, but occupiers can claim everything, as can investors. Individual investors, there are some restrictions, so individuals are denied the super capital allowances along with contaminated land. They can claim allowances called structures and buildings allowances, which Richard will explain. And pension funds and charities and the non-tax-paying sector are denied allowances on everything. Now, be a little bit careful with local authorities because quite a few local authorities have set up corporate entities to buy commercial properties as investments and to benefit from the rental profits. Those entities that own property through a corporate are entitled to claim allowances against the rental profits. What should you be doing when you buy or sell a building? We help a lot of buyers and sellers. We work with a lot of property lawyers to make sure that the appropriate wording goes in the contract. And our advice is be clear and simple. So have a clearly established position in an offer letter. Who's going to get what allowances and when? And the same in the heads of terms. Don't have huge paragraphs detailing the allowances. It will get struck out. Have very simple, clear wording. There will be a tax election for whatever the figure is, or for all of the allowances, or for no allowances. That'd be like £1. And be careful when you're reviewing what the seller says about allowances. Some sellers will complete the capital allowances questions very efficiently. Others will just strike through the whole process as not applicable. And in some cases, the responses are completely fictional. And this is where a capital allowances specialist can really add value working alongside the property lawyers. So someone who specializes in this day in, day out, as we do, is able to quickly ascertain what the position is. And one of the things that we're able to do is before one of our clients buys a building, we're able to pretty accurately model what the allowances will be, what the key issues are, what wording needs to go in the heads of terms, what wording ideally needs to go in the contract. Now, sometimes you'll succeed, sometimes you'll end up with a compromise position, and we're very mindful that capital allowances is just one aspect of buying a commercial property. But what I can say from more than 30 years of experience is if you think about this early on, you're likely to get a much better result than if you only consider it at the last version of the draft contract. It's very tricky to agree capital allowances at a late stage in the contract. And if you want to see an example of where it can go horribly wrong, Google this tax case, Gley House versus HMRC. And I would say just be a little bit careful if you're a property lawyer or an accountant and you're asked to give an opinion on the capital allowances in a report on title. It'd be advisable to have a capital allowances specialist alongside, and you may wish to limit your liability with a disclaimer, something like this one that's on your screen. So, I've covered pretty much most of the points, but I have a few further examples. So, what is when do we get excited for our clients when they're buying buildings? It all depends on the tax history. And I've referred to this as a golden scenario. And it's typically where we're looking at the history and we find that nobody previously has been entitled to claim any capital allowances. So in this example, our client is buying in 21 from a pension fund or a property developer. So they would not have been entitled to claim any allowances. And then if we find that the previous owner prior to that was also a property developer, this is what you would refer to as a clean capital allowances history, that nobody since 1996, when the legislation changed, has been entitled to claim any capital allowances. And in this golden scenario, the buyer would be able to claim integral features, general pool, and possibly some structures and buildings allowances. And if this was an office building, it may be that 35% or more of the price being paid in 2021 would attract capital allowances. So if you've got this kind of fact pattern, it's likely to have very generous capital allowances. Another situation, what I've referred to as the silver scenario, is you do your history checks and you look through the CPSE responses and maybe do some research with Land Registry. And in this case, the seller has been well advised. They've claimed allowances of £1 million, and they're insisting that the buyer signs a tax election for £1. Now, if in this example, most buyers would assume that they only get allowances of £1. However, if we look at the dates here, the former owner bought this in 2007. And if you remember when we were talking about integral features, I said that the definition of integral features was widened in April 2008. So on the face of it, this former owner could not have claimed allowances for general lighting, general power, or solar shading. So there's probably a good chance that the buyer can make a top-up claim for extra integral features and to claim these now in 2021. And again, if this was an office, or you might be able to attribute 10-15% of the price being paid in 2021 to these unclaimed allowances. So again, in this scenario, there can be substantial allowances. These are just two simple examples. There are also other opportunities. And as a specialist, we can help early on to see if extra value is available for the particular property that you're buying. My final slide before I hand over to Richard. Let's imagine that you have the great fortune to be advising these characters. And Miss Megan here, or Mrs. Megan, is buying the building currently. And, you probably didn't realize that alongside writing books, Netflix deals, she's also a seasoned property investor, alongside helping Harry with his spelling for his forthcoming biography. So let's supposing you're advising Megan, can she get any allowances? Well, you would look in the contract, you would look in probably earlier than that in the CPSEs, and you'd find out that her best friend Joe hasn't claimed any allowances. And then with a little bit of further research, you'd see that Joe bought it from his what should we call him, his nemesis, Donald, and Donald had claimed allowances of 20 million. Now, probably the reason that Joe claimed no allowances was because Donald put in a £1 tax election. So on the face of it, Donald has kept all of the allowances on this property. And a lot of advisors would say, well, there's been a former tax election made for £1, so there are no capital allowances available. However, it's very unlikely that Joe would have lived with all of Donald's gold leaf fittings, so he's probably done a slightly more tasteful renovation of this property. And it may be that if he hasn't claimed allowances on, say, 10 million of refurbishment expenditure, then you may be able to persuade Joe to recognise those unclaimed allowances within 2 years of completion. So there could be wording in the sale and purchase contract to pass on those unclaimed allowances across to Megan. You'll also note in the dates that Donald owned this in 2006. So Donald would not have been entitled to claim general lighting, general power. So if Joe is a taxpayer, we'll need him to pool those allowances within 2 years and then sign a Section 198 tax election to transfer the allowances across to Megan. So I think the key message from everything that we see in this example is it's important to consider the capital allowances early on. And if you do consider the allowances early on, you're likely to get a much better positive result. Thank you for listening to me. Richard is a much better presenter, so I'm now going to hand over to him. He's got a few slides to wrap up with, but thank you for listening so far. Please do remember to send in any questions, and I'll hand you over now to Richard. Thank you.
Thanks, John. As John said, I'm only going to be wrapping up. I know you all probably want to enjoy the warm weather. So just a quick background. I'm tax qualified. I don't quite have the 30 years experience of John, but I've been working in capital allowances for the last 4 years. So hopefully I can teach you a few things in these next few slides. So John has been talking about the structures and buildings allowances. These were introduced in the Finance Act 2019, and they're relief on all allowances that don't qualify for the plant and machinery allowances that John was previously speaking about. So John was mentioning the general pool and integral features. The SBAs apply to things such as floors, ceilings, walls, steel works, anything that you don't get your regular plant and machinery allowances on. It was initially introduced at 2% on a straight line basis, which is obviously a lot less than the 18% and 6% for the capital allowances for plant and machinery. So as of April last year, the government kindly increased this to 3%. It does apply to demolition, enabling and construction contracts, but the key point is this contract has to be entered into or on the 29th of October 2018. If you've got a contract signed before that date, then you can't claim the SBAs. It does apply to commercial property only, so you can't get it on properties such as prisons, student accommodation, so that's whether it's university accommodation or boarding school. You also can't claim SBAs on furnished holiday lets, but you can claim them on care homes. There are no clawback of allowances when you sell an asset, but unlike the general pool integral features, if you've claimed SBAs and then sell the property, you will have a corresponding increase in your capital gains because the amount of SBAs claimed are deducted from your base cost. This is obviously different to the general pool integral features. Because of this reason, SBAs are considered more of a cash flow benefit rather than an absolute tax saving. So we always advise it's worthwhile discussing with your tax advisors whether it's actually in your best interest to claim SBAs. John was talking about an S198 tax election, which is the mechanism to retain the general pool and integral features allowances. Obviously, you can't do this with the structures and buildings allowance. Therefore, when you sell a property, you have to include an allowance statement. So if ever you claim SBAs, you need to create one of these statements. And this details the amount of SBAs claimed, the date the asset was brought into use, and some other additional information. This has to be kept for the entire duration of claiming SBAs. So in theory, it's meant to last 33.3 years. Whether it does or not remains to be seen, but I'm sure we'll cross that problem when we come to it in a couple of years' time. It is worth noting that you can claim SBAs if you buy a new unused building from a developer, and the amount of SBAs claimed are the price paid less the land value, because you can't claim anything on the land value, and the plant and machinery allowances, which you'd attribute to the ones that John previously spoke about. You're entitled to claim this because the developer would have held the property as trading stock, and to re-clarify, you have to hold a building as a fixed asset in order to claim capital allowances. In the new Finance Act, there was also the introduction or reintroduction of free ports. Now, these are areas which the government tries to stimulate investment and create jobs and trade. The introduction of these free ports has been argued will increase the UK economy by £9 billion and create over 150,000 jobs. These are obviously up for debate and yet to be proven, but it sounds promising. For those who know about enterprise zones, free ports are very similar to those, except they focus specifically on companies which import goods, process them, and then re-export them. The EU currently has around 82 across it, whereas the UK has none. It used to have, I think, 7 between 1984 and 2012, but they were discontinued. So the introduction of these new ones has been met with joy from some and negative reviews from others. There 8 sites have been identified in England, and they span about they can span up to 45 kilometres in diameter. You can see the sites below, and the details of the final legislation are still to be released. And this applies specifically to kind of Northern Ireland, because people think the legislation will have to be changed due to the ongoing, never-ending Brexit negotiations. So remains to be seen what will happen there. Business operating in free ports obviously benefit from tax benefits, which is one of the reasons why the EU Parliament wanted them all discontinued in 2019, because they do have a habit of drawing in money laundering and corruption. But thankfully, capital allowances isn't applicable to that. So I'll get into the benefits for capital allowances. The first one is the structures and buildings allowance. So in the previous slide, I said that you get it at 3%, but if you're qualifying in a free port, you get it at 10% per annum, which is quite a significant boost. Additionally, you will get enhanced capital allowance for 100% for general pool and special rate pool up until the 30th of September 2026. Obviously, if you're disregarding the super capital allowances, at the moment rates are 18% for general pool and 6% for special rate pool. So that's obviously quite a big increase. You also get full relief from SDLT, but the land must be purchased and used for a qualifying purpose. There are also additional business rates relief. There are also proposals for national insurance contributions relief for new eligible employees from April 2022, or whenever the tax site is designated and actually brought into use. Super capital allowances are also available in free ports, and I know that sounds odd considering I've just said you get 100% for general pool and special rate pool, but remember the super capital allowances is only until March 2023, and the general pool is actually at 130%, so you'll actually get a 30% uplift compared to the 100%. So it is definitely worthwhile investing in them. Common misconceptions for capital allowances. So John touched on a few of these. We have missed the time limits to claim. We hear this all the time. It's simply not true. If you've still got the asset in use in the current tax year or your previous tax year that can be amended, you can claim it. So you can go all the way back to 1996. If you spent money in 1996 and you've still got that asset in use today, you can claim it. It is too late. That's the same sort of point. If the asset is still owned and used in the trade, then you can do a capital allowances claim. Benefits lost on sale. Again, people don't want to claim the capital allowances because they believe that once you sell an asset, you won't retain the benefit. And again, this isn't true. As John said in several examples, you can retain the allowances or pass them on using an S198 tax election. And it is worth noting that it can be used in commercial negotiations. If you don't need to retain the allowances, you can pass them on and say to a potential buyer, look, there is X amount of these allowances, which will save you so much in tax savings per year. Again, I'd like to reiterate, the only point is that SBAs, the benefit is lost on sale and your capital gain is increased. Very important to note that. Reduces the capital gains based costs. Again, that's only SBAs, not capital allowances for regular plant and machinery. Our tax advisors deal with this. Again, a very important one that we hear all the time. Normally, accountants will typically claim the obvious items. So they will receive an invoice which will state air conditioning, lighting. They know how to claim that. But if they just receive a contractor invoice saying stage 1 payment, £100,000, they'll normally put that towards non-qualifying and no allowances will be claimed. I'd also like to stress that if that does happen and your accountant says to you, you've got £100,000 stage payment and we'll put this all towards structures and buildings allowance, try not to let them do that, because once you categorise something as an SBA, you cannot then recategorise it in a later tax return for capital allowances. We would rather it was put towards non-qualifying, and then in a later year, you revisit the expenditure and recategorise it to general pool and integral features, and that way you get the more beneficial tax relief. This is just a tax relief segregation in order of priorities. Obviously, at the top, you've got the 150% contaminated land relief, and all the way at the bottom, you've got your structural building allowance and excluded expenditure such as land and SDLT. Post-corona impacts. So we're finding that landlords are going to be carrying out more strip out and reinstatement works, which would normally have been carried out by dilapidations. Several reasons for this. A, the super capital allowances. Landlords obviously want to benefit from these, and also because of this work from home ethic which is now developed, landlords need to encourage the workforce to come back. So they've got to make nice open spaces which make, you know, the workplace more bearable and enjoyable. We're also finding landlords capital contributions to tenant fit out, so incentivizing the tenants to stay in there. And again, it's important to note that if you're either a landlord giving a tenant contribution or you are a tenant receiving a landlord contribution, you need to have wording in the agreement for lease. The earlier you contact a capital allowances specialist, the better the result's going to be for you, because, for instance, if you're acting on behalf of a landlord, you want to put wording in the agreements for lease which says if we give you £100,000, for instance, of contribution, it's going to be attributed to the greatest capital allowances pool first and then used up until it's all gone down to the lowest pools. Landlords are carrying out more works, enhanced buildings and communal and tenant spaces. So yeah, I covered that. They need to make it nicer to, incentivize people to come back and work in the offices again. Missed opportunities by tax agents, tending to accept tax elections for low figures when buying. So again, this happens quite commonly where someone buys a building, there's a signed S1898 tax election in for £1 or £2, and it's accepted as is. But it's sometimes the case that, lawyers will know of an S198 tax election, but not know exactly what it's for. So they will put it in for £2, and it will actually turn out that the vendor couldn't have claimed capital allowances at all in the first place, which makes the S198 void and means that there's scope to claim additional allowances. Again, there can be a tax election for £100,000, but that would only be for refurbishment works that the vendor carried out, and there was additional scope to claim on the vendor's purchase, which they didn't do. And in that instance, you can engage a specialist who will speak to the vendor and say, look, you're willing to pass on these allowances, but there's an additional allowance quantum which you can put in your tax return, put in the tax selection to pass over, and it's of no gain, no loss to the vendor. So it doesn't make a difference to their tax paying, and it's worth doing. Revisiting early acquisitions. So a similar point, if you bought a building in 2009, 2005, doesn't matter when it is, there's potential scope to claim capital allowances. And if you speak to us, we can do a review and go back and establish a tax history to see if there's potential scope to claim more. And we will give you a quantum of allowances likely available. And it's something that we don't charge for. So it's always worth picking up the phone or sending an email to us. Mixed ownership structures. So where there's part pension fund and non-taxpayer, people often think that you can't claim any allowances. Again, it's not true. You can claim allowances, but only the part which can benefit and is tax paying claims their section. So how can we help? So obviously, as John said, and I've reiterated, we can go back and look at all of your past computations, see what's in there. We've got a team which is dedicated to capital allowances, and we specialize in quantity surveying and tax. We don't charge for a preliminary overview. So if you've got something, always worth picking up the phone, talking to us, and we will review the tax comps, the accounts, and go back as far back as we can. And the way we do that is we then would speak to you, provide a proposal saying, this is the likely allowances level, and this is what we would charge for it. We would either charge on a fixed fee or a savings basis. If we're doing historical purchases, we're more likely to do a savings basis, as there are slightly more higher risks involved. But on the whole, we like to think we are fair. So please don't be afraid to get in contact. Our team does include 2 former HMRC valuation specialists, which is something that no other firm has. So we're very comfortable dealing with HMRC. And in the 24 years of Lovell Consulting, there's been no claim rejected. And in the tiny chance that HMRC do query, there may be a slight change in allowance, but it's always amicable and always agreed. So we're very comfortable dealing with it. We produce a report which is put in your tax return, slots in behind, it's fully disclosed, and it's minimal fuss for any tax advisor. So it's always a good thing to do. And if HMRC do query, then we deal with all of the queries comfortably. So I think I've wrapped up just about on time. So I'll just have a look at any questions that there may be. Don't forget to contact us for CPDs and a copy of the seminar, which will be sent out. So a couple of questions. Yeah, can we have the size, please? Yes, they will be emailed afterwards. Are landlords available to claim capital allowances? Hopefully I've answered your question, but yes, they are. But again, it's always important to put wording in the agreements for lease as early as possible to avoid any conflicts later on. Again, that goes for buying and selling a property. Always speak to a capital allowances specialist early on, because wording in the heads of terms and then the contract makes it so much easier later on, rather than coming to completion and realizing there's capital allowances to be claimed and the vendor or buyer doesn't want to cooperate, which is always a bit of a nightmare. So the earlier, the better. Do you have any thoughts on the restrictions of first-year allowances, super deductions where the assets are leased and so leasing for super capital allowances is quite a lengthy answer. It might be worth having a call to discuss that, because it does depend on the type of lease and further things, which I won't go into now because I'll keep you here for another 20 minutes. And I know some of you are probably going to want your lunch. And I think that is probably all the questions. We will be emailing round answers to these questions. So the answer to the lease will be answered in an email, but I want you to go and enjoy the rest of your day. So hopefully you've learned something with us today. Thank you very much for listening. And as I said, please send us an email, give us a phone call, and we'll be happy to help with any queries that you may have. So thank you very much for listening.